The reason Bitcoin isn't worth several $100,000 by now is because it's being manipulated by the banks. You might have seen this on Twitter. People have been revolting against JP Morgan for allegedly shorting a company called MicroStrategy. Now, MicroStrategy is a company whose whole purpose is just to raise money so that it can buy Bitcoin. And at one point, very recently, the price of the stock went down to a level where the value of the whole company was $10 billion less than the value of all of its Bitcoin holdings. And that meant by buying MicroStrategy, investors were basically able to buy Bitcoin at a discount. Now, when I first heard about this, I didn't really want to make that video about the banks because it was just a rumor. But I started researching anyway, and what I found is one of the most interesting stories in all of history about something called the death or debt spiral. Now, I want to give credit to a publication in the Journal of Economics released in 2004. And what that paper found was that companies using structures that mechanically looked like what MicroStrategy is doing today ended up having their stock prices collapse. How? So let me give you a simple example throughout history, and then hopefully later on it'll all make sense. Back in the late 1800s, the Ottoman Empire borrowed a lot of money from the French and British banks, but their debt was denominated in gold. And then in 1873, the world went through one of the first big global financial crises. The European banks stopped lending, interest rates went way up, and all of a sudden, the Ottomans couldn't create new bonds to pay for the old ones. At the same time, their currency was getting weaker, and how that looked like to them is the same way things look like to us today, which is things relative to that money go up in price. In this case, gold. We're like, oh look, gold is becoming more valuable. No, your currency is just getting weaker. Okay, so eventually the Ottomans couldn't pay it back and they defaulted. But the banks were like, you still owe us money though, right? So in return, the bondholders, which were the French and British banks, forced the Ottomans to create a new institution called the Ottoman Public Debt Administration. It was basically a foreign group of bankers that took control of the empire and their money, specifically the control of how taxes were collected and paid back to them. Now, this happens time and time again throughout history though. Greece, for example, more recently borrowed hundreds of billions of euros, a money they could not print more of themselves. So in 2010, when their economy collapsed and their borrowing costs went way up, they couldn't pay it back. So the IMF, which is the International Monetary Fund, forced Greece to create a special fund called the Hellenic Republic Asset Development Fund. And its whole purpose was to take control of the most valuable pieces of the country and sell them off so that they could pay their debt. Now, these are just two overly simple examples of the death spiral happening to countries and empires throughout history. But what's even more interesting is that this can also happen to companies and their assets. And that's where this story begins. So with that said, let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the debt spiral. So here's where things get really interesting. In the early 2000s, regulators discovered something that sort of paralleled what I described, and it destroyed hundreds of companies. In 2001, the SEC actually opened investigations into a financing structure called PIPEs, which is short for Private Investments in Public Equity. Now, a portion of those PIPEs were what's called floorless convertibles, meaning the lower the company's stock price went, the more shares the lender got when converting their debt. And what that meant was that lenders could hedge by shorting the stock, knowing their bond still guaranteed repayment. So the falling stock price didn't hurt them. And here's how this looked like in reality. First, a company like a tech startup or an internet company would run out of money. So traditional banks wouldn't want to lend them money because they were considered too risky. So in comes a hedge fund or a specialized investment bank offering something that sounds really helpful. We're going to lend you money, but instead of paying us back, you could give us more shares. We'll just take your stock. And if your stock goes down, don't worry, we just get more stock, right? Easy. It adjusts automatically. Now, to a desperate company, that sounds really good, but this adjustment mechanism where the lower the stock price goes and the more shares the lender gets is what gives financial incentive for the company's stock price to fall. Because the lower it goes, the more shares the lender gets. And once they get those extra shares, they could sell them into the market, which does what? Pushes the price down even more, which gives them even more shares, which they could sell again, and so on and so forth. In a study published in 2001, the SEC reviewed hundreds of these cases, and what they found was that on average, investors who bought the stocks of these companies lost about 34% of their value within 1 year. And this happened during a bull market where stocks were going up. By the end of it, about 85% of those companies had negative returns after creating their toxic debt, and about half of them didn't survive. 48% of those companies were delisted. And I think this has some parallels because MicroStrategy does have several billion dollars of convertible notes. Even though lenders don't receive more shares if the price falls, the risk does not come from the conversion. It comes from the moment that they run out of cash while the stock is trading under value. So that's why people worry that MicroStrategy either has to sell more stock or sell their Bitcoin, and that would be the beginning of the debt or death spiral. So the question is, who's doing this and why? And to answer that, I need to break down exactly what kind of debt MicroStrategy has, who they owe it to, what the terms look like, when the bonds mature, and whether there's any realistic scenario where Michael Saylor has to sell his Bitcoin so that it triggers this death spiral. But first, here's something I've been personally doing to keep stacking sats while all of this plays out with the Gemini credit card, the sponsor of this segment. It's a card I've been using for a while now, and all opinions are my own and they were not influenced by a Gemini. I use it like any other regular credit card for gas, groceries, and travel, but I earn Bitcoin every time I use it. It has no annual fee, and you can see rates and fees in the description for more info. You get up to 4% back in over 50 cryptocurrencies instantly, and you can choose which one you want. Personally, I have mine set to Bitcoin, but that's 4% on gas, transit, and rideshare, 3% on dining, 2% on groceries, and 1% on everything else. It's a MasterCard World Elite. I've used it internationally with no problems, and every time I use it, it adds Bitcoin to my portfolio. And the best part is, you're investing as you spend. In fact, according to Gemini, cardholders who earned and held their Bitcoin for 1 year saw an average appreciation of 279%. And those are not your typical credit card points. So if you're interested, click the link in the description or go to gemini.com/Andrei to get $200 in Bitcoin when you spend $3,000 in your first 90 days. Thank you, Gemini, for sponsoring this segment, and now let's get back to it. So let's talk about what MicroStrategy actually looks like today, and I want you to get comfortable because I'm probably gonna put you to sleep. This is about to get very nerdy. You're like, oh, now it's about to get nerdy. All right, so MicroStrategy is basically a giant Bitcoin fund with a small software company stapled to the side of it. And in their latest presentation, they showed that they now hold around 650,000 Bitcoin. That's worth roughly $59 billion, depending on the day you look at it. Now, that $59 billion pile of Bitcoin cost them about $48 billion. In other words, they are now sitting on an unrealized gain of more than $10 billion. And now they control something like 3% of all the Bitcoin that will ever exist. Okay, so those are their assets. Now, against that are their liabilities, which is about $16 billion worth of obligations or debt versus the $59 billion worth of Bitcoin. This is why they love to say that their LTV or loan to value ratio is about 11%. Now, is that good or bad, right? For context, 40 to 60% loan to value is generally considered acceptable for the stock market. So yes, 11% is very low, it's good, and it sounds very conservative. If I stop the story here, it sounds like there's no way anything could go wrong. They own a mountain of Bitcoin, right? And a small pile of IOUs. But there is a catch to all of this. That $16 billion IOU pile has a price. Between the interest on their debt and dividends on all those preferred shares, MicroStrategy now owes about $800 million a year just to keep the machine running. That's over $2 million per day. Now, unlike A normal common stock dividend, and if you're a dividend investor, you already know this, but a preferred stock dividend cannot be turned off. A common stock dividend, a company can just stop paying you the dividends whenever it wants, but not preferred dividends. Why?